Hello, this is Greg Sierra, and let's see if we got this video recording. Looks like we're good. I'm going to do in this session the accounting cycle problem that was assigned as homework. Part of it is to give you the solution. The other part is to give you a systematic method of completing the problem. So what I'm going to do is actually start the timer. So I'm explaining this to you and I'm doing it, and you'll have a half hour on the final. I will break up this video into segments because it's just practical. Having too large of one video is difficult for a variety of reasons. But we're going to start on this first one, and we're going to do the journal entries, which is the first place. So I'm going to do start the timer now, and with explaining and doing the journal entries, we'll see how long this takes. All right, so here are the 4 journal entries that if you've attempted the problem, you'll be familiar with. So this first one says they purchased an auto manufacturing parts machine for $50,000 on January 1 of 20x5. So I'm noting in my mind that that's the full year. The machine has a useful life of 5 years, a residual value of $5,000, and it's straight line method. So it's very nice here that I give you the adjusting entry. You have an expense, and then you have a contra asset account, the accumulated depreciation, which is classified with the assets. Okay, so just as a reminder, an adjusting entry, which trues up the books to create financial report for a reporting period, involves a temporary and a permanent account. That is, involves a revenue, expense, and an asset or liability. So straight line depreciation, I have the formula here for you to review. And we bought the thing for $50,000. They told us the residual value was $5,000. The useful life estimated is 5 years. That's 45,000 divided by 5,000 equals 9,000. Go back to my Excel file. So you would be doing that on your scratch paper in the test. Okay, so we got that in there. Depreciation adjusting journal entry again. So let's read the facts. Hanol purchases an auto parts manufacturing machine for $20,000. January 1, full year. The machine has a useful life of 5 years and a residual value of $3,000. Record depreciation expense for the year under the double declining balance method. So this one is a little different because the double declining value method is a little bit different. So we have 2. 2 is why it's double, and it's doubling the rate, which will be 1 over 5, 1 over the useful life. And it's times the carrying value. So if we go back here, it tells us that it's 20,000. It's the first year, so we haven't depreciated anything. So the carrying value is still 20,000. Here's the tricky part. Double declining balance uses the carrying value and doesn't consider the residual value to the end. So in the first year, we don't have to worry about the residual value. Okay. If it had been acquired during the year, like on July 1, I'd put 6 over 12, but we don't need to do that. It's not a partial year. You may get a partial year on the exam. Totally fair game. And we put that all together, and that looks like 8,000. Okay, so you'd be writing on your scratch paper, 8,000. I can't believe he made this final exam so easy. So here we go to the, let's see, what are we doing? Interest expense, adjusting journal entry. They take out a 5% loan for $80,000 on February 1st. Oh, so this one is going to be a partial year. The loan requires that interest be paid once per year on January 1. So we're going to adjust for all the months in 2005 up to December 31. Record so we don't have an intervening payment. All right, so the full amount of the payment accrued up to December 31st has to be recorded. All right, so let's see what we have here. 5% times 80,000. So this little formula, 5% times 80,000 in principal. So it's on February, it wasn't February at the end, it's February 1st, so that's 11 months out of 12. Okay, so 5%, 80,000 times, 11 times, 12 divide. Not a very pretty number, but and you round to the nearest dollar. Financial accounting is to the nearest dollar. All right, except if it's earnings per share, but all the balance sheet and income numbers are to the nearest dollar. So 3667, 3667, 3667. Now this last one is an income tax expense adjusting entry. The difficulty with this is we need to calculate income before tax expense to calculate it. So we're going to have to go into the income statement and do the three adjusting entries above and figure it out from there. So on your test, I guarantee you're going to have the income tax one. Okay. So we go to our adjusted trial balance, and what I suggest you do is start with the expenses down here. So all I have to do for depreciation expense is say equals the first one plus the second one. And then you don't want to forget to do the opposite side. These expenses are going to be credit somewhere, right? So that's 17,000. We have the interest expense, and you'll have the Excel file on the final, so this is totally legal. So let's see, interest payable. Okay, a lot of the times you have mistakes because you forget to do debit credit. Okay, now what you want to do to make sure you didn't forget a debit or a credit is sum each column. Sum each column, okay? I sum that column, oops. Now I can just copy paste the formula over here. And as long as I'm here, I'll just copy and paste over here, okay? All right, so the adjustments are equal. Since I have the two unadjusted balances equal and my adjustments are equal, I know everything's going to balance. Could be wrong. For example, I could have calculated 20,000 of depreciation expense and the number would be wrong, but it would be balanced. Okay, so now that I've done that, I've posted these. This is the last thing I'm going to do on this portion of the video. So I'll notice that the ending balance, that is going to be 17. The ending balance of this interest payable is going to be the 3667. Oops, that's nice that I highlighted it for you guys. I almost made the mistake of putting it as a credit. And that's there. And we added the same amount of debits and credits, so even though the balance changed, we have, it's equal. So check that your balance is balanced. All right, if they don't balance, it's wrong. If they do balance, they may not be correct because you could have offsetting errors, but it's definitely wrong if it doesn't balance. Okay, so at this point, what I'm going to do is pause the recording. Let me check my time. Pause it. Looking pretty good on our time. We still have over 24 minutes to go, or excuse me, 22 minutes to go. And the other stuff will come together pretty quickly. Let me get up here, pause for the cause, or stop, and then I'll come back and we'll do the last adjusting journal entry, and then the final part we'll put it all together.